Welcome to Mid-State Money Talk. My name is Cynthia DeFazio, joined today by Joe Dietrich and Al Dietrich of First Choice Financial Services Incorporated. To our viewers at home, today's topic is how to navigate the decreasing interest rate environment. Why is that important? We're going to do a deep dive into why it's important to have quality information regarding this, especially when it comes to planning for your retirement. Joe, how are you today?
I'm doing well. Good to see you.
Good to see you too. Al, how are you?
I'm fine, thanks. Nice seeing you.
Nice seeing both of you. I'm excited about today's show, and I found an article recently, and I think that this sums it up best, viewers at home. So I'm going to read for just a moment, if you will. Much of the economic market news over the past year has been focused on changes on interest rates. The Federal Reserve's interest rate policy significantly influences the U.S. economy by affecting borrowing costs. Higher rates typically slow economic growth. They combat inflation by making borrowing more expensive, while lower interest rates stimulate activity by cheapening loans. Well, these overall factors increase consumer spending. So I have to ask you, Joe, why is it important for us to have this conversation with our viewers today? Why does this decreasing interest rate environment cause some questions and concerns, or can people just get comfortable?
Yeah, absolutely. I think if we're going to think of a slogan for it is that we have short memories. You know, we kind of get comfortable in the environment we are currently. So it's nice to take a look back a little bit and think after COVID, 2020, 2021, what did things look like then? You know, so COVID, the markets are going down, they're recovering. 2022, we had an 18% drop in the S&P. Things are started going back up, you know, so we've got that market volatility. What was interest rates look like during that time? Well, in 2020, interest rates were hovering around 1.5%. You know, now in 2022, things started to go up sharply. Those interest rates went up quite a bit. By August of 2023, 5.25%.
Wow. Okay.
Right? Well, about a year later, so September 2024, we're down to 4.5%.
Yes.
December, we go back down another quarter point. So December 2024. We know that the Fed is hinting at maybe 2 more cuts in 2025. So here we see we're not only having market volatility, we're having some volatility in the interest rate environment as well. So what does this all mean? And really, I think that what I started out with is that we can't get comfortable where we're at. We always need to be educating ourselves and looking forward as to what our income plan and needs are.
Absolutely. And gentlemen, I should ask, how do falling interest rates affect savings accounts and CDs? What happens with that situation?
Well, yes, we, like Joe says, we have short memories.
Yes,
yes. And we do. And so we have clients come into the office and they say, you know, I'm a little discouraged that interest rates are start going down. I went from 1.5% to 5%. Now we're down at 3.5% and 4.5%. And I said, did you reestablish your spending plan on the higher interest rates? Well, we were able to go do more and buy a lot more things. Okay. Well, that's why you have income planning, so that you can have long range planning. And in those periods of time when you have a higher rates of return, you can't afford to go and do some of the things that you want to do.
Sure.
But, you know, what our goal is so that you don't have to plan your paychecks here and there and everywhere, that you invest in the appropriate accounts at the appropriate times, so that if you do want to go here and there and take your family or your spouse or buy something particular, that base income is always there to support you. You have that support level.
Okay.
Yes.
Very important to have that, because we talked about paychecks and playchecks.
That's right.
So thank you for referencing that.
Sure.
Joe, what happens actually to the bond yields when interest rates begin to fall? What happens there?
Yeah, so, you know, whether you're in stocks, bonds, your money's in the bank, these are all going to be impacted by the interest rate environment. Bond yields, everybody loves to talk about bonds. They can be a little confusing, but so if you've got a bond yield that's in a great interest rate environment and you get 5%, that's wonderful. But I mean, the new bonds that are now being issued in a lower interest rate environment, well, they're not getting 5%. They're not paying 5%. They're paying 4%. Well, what does that mean for us, right? It means a couple of things. It means that, you know, the income you're going to be getting from that same amount of money you're investing is going to be lower.
Okay.
Certainly. Okay. But it also means that those existing bonds at 5%, they're actually the market value of those bonds. The face value is actually going to go up if you were to try to, say, sell them. Now,
Okay.
if you're going to keep them to maturity, maybe that doesn't impact you so much. But if you're going to sell them, that sounds like a good thing, right? There's some other interesting things that are going to happen, however, that not many of us have individual bonds. Maybe we do, maybe you do. Most likely you have a bond fund. And so there's going to be a conglomerate of different bonds that are in there. And as those are then being rolled over or sold or bought, that yield on those funds are also going to be impacted by the interest rate environment.
Okay. Okay. Yeah. What about reinvestment risk when it comes to bonds and we have a decreasing interest rate?
Yeah,
what does that
absolutely.
do with reinvestment?
Well, reinvestment risk is what I was talking about. We're in that bond fund.
Okay.
But even if you had individual bonds, okay, so your bond that you had at 5%, you were happy with that. But now you have to go back and it's come to maturity or was called. You have to go get another bond. It's going to be at 4%. Well, is that going to have to impact your spending, like Al said? Is that going to be an impact on your bottom line? How do you plan for that? Bond maturity or bond duration is kind of a measure of risk or volatility with the bond market. So you need to consider that as well. How long is the duration of your bonds? The longer the bond, obviously the more sensitivity to that interest rate change. As interest rates go down and the bond values go up, vice versa, interest rates go up, so we're always fighting that balance of inflation, of interest rates going down. But a longer duration on that bond is going to have more volatility or more sensitivity to that interest rate environment. The shorter ones, not so much. This is all things that we need to consider when we're putting together an investment plan, an income plan on where we're drawing that income from.
Absolutely.
Is this bond market appropriate for us to be drawing income from?
Absolutely. Yeah. Al, I should ask you, how does this specifically affect retirees, those that are saving for retirement with these interest rate changes? What are they concerned about? What are they thinking right now?
Well, they're thinking, what do I do? Now is when you see a lot of folks who have their monies in savings accounts and CDs. They're looking at different banks. Which one's going to give me a quarter of a point more than this? And, so they do the same type of investing concepts with CDs that they would most likely do with bonds and so on. It's just another product for themselves. But you're right. When interest rates go down, it affects your lifestyle.
Absolutely.
And so then, if you want to maintain a lifestyle, now you have to take more out of savings. And of course, if interest rates are up, you talked about that a little bit. For the most part, you're going to see a lot of the stock market come down a little bit. Yeah. Interest rates go up, stocks go down. Stocks go up, interest rates tend to go down. Not always, but they tend to.
Okay.
And so it's just something that, we deal with every day. Folks come in and say, now what do we do? But if short-term interest rates do fluctuate up and down, and you're accustomed to using that money for things, that's where we bring other products into play because, if you get a 5% interest rate on a 9-month CD, you like the 5% and it renews and now it's at 4.5. Well, if you'd have taken that same money and put it in and you're using the return on it and put it into a different type of investment that might give you that 5% for 5 years, versus 9 months, that's something that you need to take a look at.
Absolutely. And gentlemen, you hear these questions and concerns every single day. So Al, I should ask you, the customized retirement plan, the complementary retirement plan, how does that actually help address these factors to our viewers at home that are asking that question right now?
Well, we take account for those type of things. During your life of retirement, could be 30 years. Obviously costs are going to go up in 30 years.
Absolutely.
So we have to do some advanced planning and we say, well, your income may be sufficient at this point in time, but, we need to have funds available so that when you need an increase in pay, increase in your expenses are increasing, so you need an increase in pay to take care of those. We already have that planned into your program. Without that, now you're searching and you're lost. You just really don't know where to go with it. So that's why it's so important. You don't go from here to California without a map.
That's true.
Right? So we provide you that map and we provide for detours in that map.
Absolutely. Absolutely. So it's peace of mind and there's hope.
Exactly.
100%.
Exactly. Yeah.
Gentlemen, thank you so much. To our viewers at home, there's a number to call on your screen. That number is 888-959-2743. If you're in the viewing audience today and you're asking yourself, do I have a plan for my retirement? Will my retirement be affected with higher interest rates, with lower interest rates? And if you're unsure, this is the perfect time to have the customized retirement plan completely drawn up for you, absolutely complimentary, no obligation. But you have to do one thing. Call in to 888-959-2743. Again, it's 888-959-2743. If you don't have a pen handy, just grab your smartphone, click on that QR code at the bottom corner of your screen. That'll take you right to the landing page for First Choice Financial Services Incorporated's website, and you can actually schedule your time accordingly. We know that you have a lot of questions about how to plan your perfect retirement. These gentlemen are offering the answers to you. When we come back, we're going to talk about how do lower interest rates impact the stock market. Stay tuned.
When we tell someone something, they'll say, we can take that to the bank. If we can't do something, we'll tell them that. We're straight up with our clients. It all comes down to using the products for the people's needs, not selling product.
Being independent means that we have freedom to do what's best for our clients. We're not beholden to any other party to make sure that we're meeting a quota or restricted on what it is that we can do or provide. We're free to go out into the market and find what's best for them and what's going to meet their needs.
The world's our oyster, as far as what resources we have for our clients, and that's beneficial for our clients more than anything.
Don't be afraid to go ask for help. Find somebody you can trust and start the process. Obviously, the financial part is very important. Having a plan in place that's going to provide you with sustainable income, that's resilient to the changes of life and of the market, that's really important.
Money doesn't care who it serves. And one of the things that we like to do in our company is we like to be able to help people determine where their money is going to be and who it's going to serve generation after generation.
Welcome back to Mid-State Money Talk. My name is Cynthia DeFazio, joined today by Joe Dietrich and Al Dietrich of First Choice Financial Services Incorporated. And we're talking all about what happens with this new low interest rate environment that we're in. How does that impact our overall retirement plan? These gentlemen have the answers for us today. Joe, I want to ask you a very important question. How might lower interest rates actually impact the stock market? What happens there?
Yeah, that's a great question. And while none of us have a crystal ball. We don't know exactly. And there's a lot of complicating factors. We have some generalizations here that we need to understand. With lower interest rates means that the cost of money, the cost of borrowing, can be lower. So what is the stock market? We're investing, we're buying a piece of individual companies. They might be cobbled together with a mutual fund or an ETF or some sort of blended fund, but ultimately they boil down to these are real companies. And
Absolutely.
So that's impacted by the interest rate environment. If you're able to borrow money at a lower rate, that's going to be helpful in your profitability, right?
Sure.
Income in, income out, right? If I have to pay less on my debt, that's going to be helpful. So company valuations, profit to loss
Absolutely.
ratios are going to be better.
Yes.
This could be attractive. So this could help company valuations go up.
Okay.
The other thing is that we've seen in the past that consumer spending increases with lower interest rate environments as well.
Makes sense.
So those correlate. So the more people are spending, the more money is going to companies, the more profitable they are. So these are some general trends. There's no specific advice there, but general trends that in lower interest rate environments, we tend to see stock markets increase.
Makes sense. Makes sense. Obviously, the interest rate environment is one predictability factor, if you will, of stock market performance, but there's also some other things. It can be a little bit confusing to really figure out what affects the stock market. What are some other things that people need to be aware of that could affect this?
Yeah, absolutely. There's going to be a lot of factors in the general economy, and you'll see news that talk about unemployment rates and earnings reports from particularly large tech companies. There's a lot of this, just general economic conditions are going to impact the overall stock market trends. Geopolitical events could also impact this. And then obviously, we already talked about this, the underlying valuation of all of those individual companies should be and are the most important factor of what's going on in the stock market.
Absolutely.
Healthy companies, healthy stock market.
Absolutely. Is it important for people to have diversification of one's money when we're talking about the lower interest rate environment? What is your specific opinion on that, Joe?
Yeah. So we've talked about bonds, we talked about stocks, we talked about banks, and in overall terms, this is a great time to make sure that we look at our overall portfolio and make sure that it is diversified, that it's balanced, and it meets our goals and objectives. Right. So whether we need to be moving from stocks to bonds or bonds to stocks in each individual environment is a tough decision. And we try to help educate our clients they get monthly newsletters. We're obviously keeping track of these things. We're in touch with them. We're having sit downs and rebalancing those accounts for them. So, if you're not working with somebody, us or somebody like us, this is a time to call and sit down and make sure that your accounts are balanced and diversified and ready to meet your needs.
Would that be more specifically, Al, specifically in the retirement years for folks to really make sure that they have a good balance so that they have peace of mind? We talked about paychecks and playchecks and how someone's overall investment strategy needs to be comfortable for them. So talk a little bit about that.
Yes. There's, we always say we don't know what we don't know.
Exactly.
Okay? When you hit retirement, that's the first time you're going to most likely access your retirement funds. And when you do that, it sort of puts another hole in the funnel, so to speak. If you have a funnel and you have one exit, that's one thing. But when you take income, you put another hole in the funnel. So, just like if you have it in the market and the market starts a certain way, at the end of that, even with income, based on how the market performs, you can have a substantial amount of cash left in the market. But let's say the market performs poorly during that period of time. It can really have an adverse effect on the balance that you have in your account.
Sure.
Okay. And so when folks come in, they always say to us, boy, I wish I would have seen you sooner. There's so many things that you brought up that we were never told.
Yeah.
We just don't know about those things,
True.
And so we're talking about lower interest rates. And so, again, it's the importance of having a plan that takes that into consideration, And so...
we want to be structuring, we're going to have cash. You should have some cash in your plan, right?
Yeah.
How much of that should be there? How long should we have reserves for some guaranteed income, regardless of what the stock market is doing or the bond market is doing? Should we be considering some alternative investments? Should we be involving some commodities or real estate or insurance products that create a balanced portfolio? But we like to approach it from what we call an income plan, not necessarily just, well, what's the portfolio and we're skimming off the top, that sort of thing. So particularly those alternative investments and insurance products can help us provide other income streams.
And also, I'm assuming would help alleviate some of the emotional responses that people have when they see like interest rates drop, they go up, they don't know what to do, they panic. Do you see a lot of people that just get really nervous and make emotional decisions, Joe, before coming into the office, of course? Yeah,
absolutely. And we always seem to rely on some generalized knowledge or generalized information we get from the internet or just the scuttlebutt, that sort of thing. And if you're not working with somebody, you really need to sit down with them and walk through and create that income plan. We like to talk about guaranteed lifetime income. If you've got Social Security, if you've got pension, you're blessed. Like that's meeting most or all of your needs. That's great. But for a lot of people, that's not the case. And so there's what we call an income gap between what can be guaranteed for the rest of your life and what you're going to have to rely on in your investments. So putting a plan together, to include that guaranteed income is something that we talk a lot about and include in our planning.
Risk and reward, So folks come in and they're telling us they do a risk tolerance questionnaire with us.
Okay.
And it shows that they may be more on the conservative side today than they were before. And they've had these conversations with their 401k and their investment advisor. But when we take a look at their portfolios, it's still very, very aggressive. And that is what will get them into trouble.
Absolutely.
When they insert that other hole in the funnel, and now income needs to come out of that. that is what gets them in trouble. So you really need to have a risk tolerance that the advisors can go by. But even so, when they come into our office, we take a holistic approach to it. So we're not saying one risk tolerance is right for everything.
Yeah.
You know, we want to secure a retirement, an income plan. Well, now we have the paycheck money.
Yep.
Okay, now we can be a little more aggressive if you'd like to be, but without the volatility that will kill you.
Absolutely.
So yeah, we have an opportunity to look at each of those areas. We talk about a 5-step approach. We have the ability to look at each of those 5 areas and analyze how much should be put where.
I love that. I love that, Al. Thank you so much.
Sure.
Joe, thank you so much. To our viewers at home, we know that you're in the viewing audience today and you're saying, I need to have one of these customized retirement plans so that I have peace of mind no matter what the interest rate environment looks like. You can do so. You can grab one of those by calling in 888-959-2743. You're being offered a complimentary consultation to have a beautiful, customized, written retirement plan drawn up for you so that you can have peace of mind in your retirement years no matter what happens that we see with the interest rate environment, the stock market, what have you. Peace of mind is priceless. 888-959-2743, or you can grab your smartphone, click on that QR code at the bottom corner of your screen, and you can schedule your time accordingly. We're going to take a very short commercial break. We have more strategies for the decreasing interest rate environment when we return.
When was the last time you saw your financial professional? Are you getting the most out of the strategy that was created for you? Although you've done a great job finding someone to help plan for your future, are you 100% sure that you were given the right strategy? We can help answer these questions and more with a complimentary second opinion evaluation. We will take a look at what you have in place and then help determine if you're well positioned to get the most out of your future retirement income. In the event that it is not, we can help by making suggestions and showing you how to get on the right path. You wouldn't get just one opinion when it comes to a major health decision, so why would you treat your most important financial decision with such disregard? Call today for your no-cost, no-obligation second opinion evaluation to see if you're getting the most out of your retirement income plan.
Welcome back to Midstate Money Talk. My name is Cynthia DeFazio, joined today by Joe Dietrich and Al Dietrich of First Choice Financial Services Incorporated. We're talking all about the decreasing interest rate environment and how does this affect your retirement plan overall. Joe, I want to ask you a very important question. Should retirees reconsider their withdrawal strategy when interest rates drop? What happens there?
Yes. This is a great time to be reassessing your withdrawal strategy. Perhaps you haven't really given much thought as to it being a strategy. Maybe it's just a matter of, I've been lucky enough to have enough cash that's been holding me over now. The higher interest rates environment have been providing, benefits from my cash that have not required me to start withdrawing funds. That may not continue in the future. So reassessing your withdrawal strategy now is a great time. We may have heard of something called the 4% rule.
Yes.
So there's a lot of strategies out there. There's a lot of thoughts on this. The 4% rule is kind of a generalized rule of starting with 4% to try to make sure that your portfolio doesn't run out of money. It relies on a lot of assumptions. And we found over the years that those assumptions rarely fit in with the individual's risk tolerance, portfolio makeup, their spending needs. So lifestyle is really important consideration here. Your withdrawal strategy should be meeting your goals and objectives. So I want to think about this. So think about a triangle, right? In our life, we've got health, we've got money, and we've got time. These are our most precious resources,
Absolutely.
right? When we're early in our years, we have all the health, right? We don't have a lot of money. We may have a lot of time. And then as that goes and we've got some kids, well, all of a sudden, time pretty hard because we're working, we've got kids, we've got a spouse, like a lot of time. Still probably not a lot of money, but we still got kind of health. Well, there's going to be a time where you got very little health, but you might have a lot of money, right? So there is going to also be a time in your life where that triangle is almost equal distance. You got health, you have money, you have time. These are the golden years, and we want to make sure that we plan for those, right? So those times where you want to be able to go and do those things that you always wanted to, you're starting to slow down working or stop working. these are the times that we want to maximize. So our planning wants to focus around that. We certainly don't want to restrict our spending, and the 4% rule sometimes does that early in our retirement. Then all of a sudden we've retired and we actually got double our portfolio, but guess what? We don't have the health to use it.
Yeah.
Right?
Or
So
the
these are the
time.
type of things that we want to consider when we're putting together an income plan. Your lifestyle, it should match you. So if you don't have a plan that is going to match that type of lifestyle for you, pick up the phone, call the number on the screen, take your phone out, scan the QR code. Please give us a call. We would love to meet with you.
Thank you, Joe. And I love the triangle analogy.
Yeah.
I've never heard that before, but it makes perfect sense. Thank you for sharing that
You're welcome.
today.
Yeah.
Al, I want to ask you a question regarding Social Security considerations, because I know
Okay.
that people are always thinking about Social Security in every environment, but with a low interest rate specifically, how does it factor into Social Security, if you will?
Again, we take a planning approach to it. So, we like to take a safer approach to retirement.
Yes.
Look at it a little more conservatively, because the number one concern is running out of money.
Absolutely.
And so, again, that's why the Social Security question is so important. That's why you need to sit down. You should sit down with someone
Yes.
who can take your goals, your plans, your lifestyle, your spending habits, and look at that and determine where Social Security can best fit to help you in that retirement process.
Okay.
When people look at Social Security, they always say, well, I'm going to consider taking it now, and I'm going to consider taking it at 70. What happens in between?
Absolutely.
Right? And that's where 99% of the people should be taking it, in between there.
Yeah.
So we want to find out not which plan will generate the most money down the road. We want to find out which plan will be able to provide you the needs at 65, 70, 75, 80. And then the other part of the plan is where we're coming up with the other investments and saying, okay, we need something to plug in here. Where are we
Yeah.
going? What option are we going to use here for these couples?
Al, thank you so much. Joe, thank you so much. To our viewers at home, most specifically, thank you for spending time with us today on Mid-State Money Talk. As you can see, you need to have the customized retirement plan so that you can withstand any interest rate environment. Again, the number 888-959-2743. Be safe, be happy, be blessed. We'll see you next week.